This is by far the most popular series on this channel, and it brings in a ton of subscribers every single month. So if this is your first time here, consider subscribing to join the community as well. And if you're a returning subscriber, you know what time it is, and that's 3 stocks to buy for October 2019. And I just kind of want to throw this out there. With the markets currently pretty much at all-time highs, it doesn't hurt to be a bit more cautious and maybe build up a cash reserve on the side. I personally have been doing this, trying to build out my cash position to be a bit larger in my portfolio, but I'm still going to take advantage of opportunities that do pop out there in individual stocks. Now, I do believe the companies we're going to cover today, at least 2 or 3 of them are at good valuations, and I would actually consider buying them today. So let's get right into it, guys. And the first stock that we're going to cover this month is Best Buy, ticker symbol BBY. So it's very odd for me to talk about a retail company, especially since I'm a very big fan of e-commerce and e-commerce giants like Amazon. But that being said, Best Buy isn't your typical retail company, and they've actually done a pretty good job expanding their e-commerce efforts. So let's start off by looking at their latest earnings report, which was quite impressive if I do say so myself. They had increases across the board, comparable sales were up, EPS increased, and they raised their guidance for the year as well. All of this signals to me that they had a great quarter and they see increased strength in the back half of 2019. Looking deeper at the breakdown, there was one main flag though, which I wanted to note here, and that is while domestic sales were strong, international sales showed signs of weakness and it was actually down year over year. This could mean that either Best Buy is losing their footing in the global market, or it means that global economy is slowing down. I personally believe that the second scenario is most likely the case here, because we have seen other companies also signal and state that they are seeing weakness globally. And this is really supported by their statement here, which essentially clarifies that the weakness was in Canada and was due to Forex exchange rates as well. The Canadian dollar isn't doing so hot lately if you haven't been keeping up with it, and it keeps getting weaker versus the US, so this weakness may continue in the future quarters as well. So why Best Buy? Well, I like that they're actually a growing company, and I actually do also like that they pay out a consistent dividend. Here you can see the consistent performance, beat after beat, quarter after quarter, and there's a lot of growth ahead expected as well. You'll notice that quarter 4 actually has high expectations here for the company, and that's because it's during the holiday season when retailers like Best Buy are expected to perform extremely well. Jumping over to their dividends, Best Buy has a strong dividend growth here for the last 5 years, with an average rate increase of 22% year over year. They currently have a starting yield just under 3%, however with low payout ratio of 37%, there's plenty of room to grow this dividend in the coming years. Now I know you like looking at the SMART score from TipRanks, and here we can see Best Buy has a current rating of 4, which is fairly neutral. What has me a bit concerned here is that hedge fund activity as well as insider activity are both currently selling shares of Best Buy, despite the stock having a moderate buy rating. Other metrics look fair, and with their current PE around 12, this is looking like a very attractive valuation in Best Buy, all things considered. And based on the last 15 years, it is actually trading under its average PE despite strong sales and growth. And the 4 PE based on expectations is actually in the 11s. So this is another positive, as it is expected to come down over time. Jumping over to the charts here for Best Buy, they had a correction of 44% at the end of 2018, which is pretty drastic in my opinion, which in hindsight was the best time to buy. However, even today you can see the stock is consolidating after recovering about half of what it had lost, and I believe this will be somewhat a market trade. This means that if the market starts rising and rallying, I believe Best Buy will also rally with the market. But if we see recession fears, Best Buy will continue moving sideways or even decline. Keep in mind that during a recession, or when we're entering a recession, typically investors will flood out of stocks like Best Buy because it is a retail stock, and there's a high chance for a lot of those type of stocks to actually go bankrupt during recessions. So I would not be surprised to see Best Buy taking another haircut if we enter a recession. So I think it would be actually a good idea to keep an eye on Best Buy here going into October. And if we drop back into the 50s, I think it may actually be a very good opportunity to load up on shares. Combining their low PE, their low forward PE, their strong growth, and their strong growing dividend, this seems to be a very good stock to hold for any investor really for the long term. Now we're going to move on to our second stock here, which is Netflix, ticker symbol NFLX. This giant in the streaming space was once the sole provider of streaming content. However, competition has started picking up up with Amazon, of course, with Amazon Prime Video, and now we're seeing Apple and Disney enter the space as well. And investors do realize this as it's reflected in their stock, as it's been a rough ride for investors for the last year in Netflix. Now, I'm not going to waste time explaining what Netflix does because most of you watching actually probably have a Netflix account already. However, I do want to discuss two things that I believe that Netflix is focusing on as a company moving forward. The first thing that they actually want to put a lot of money into their own original content, so you get more shows like Stranger Things, 13 Reasons Why, and even House of Cards, or other shows that are really Netflix originals. That's one main focus area. The second main focus area is actually putting a lot of money into licensing existing content that's only available on Netflix. So some examples of this is that they have The Office and Friends currently on there, but they actually recently signed a deal this past week, signing Seinfeld starting in 2021. But the problem is that both of these things come at a cost, and a hefty cost at that too. Original content can cost billions to make. And recently, like I said, with Seinfeld, they actually spent reportedly above $500 million to get those licensing rights. And this is a concern because Netflix doesn't have the strongest balance sheet. They're currently sitting with around $3.8 billion in cash and investments. And this is in contrast to around $10 billion in long-term debt. However, since it is long-term, it does reduce the risk here because they don't have to pay it off anytime soon. However, it is something that the company will have to keep an eye on because they have to manage their spending so that it is manageable over the long term. Now, I may have been able to look over their debt if they had a reasonable valuation, but you can see here that their PE is actually at a sky-high 120. This makes it extremely expensive and very hard to justify its current valuation when you consider the competition entering the space. What worries me is when you look at their earnings, yes, they have done well on beating thus far. However, 3 of the next 4 quarters are expecting triple-digit growth percentages year over year. Those are sky-high expectations if you ask me, and something that will truly put pressure on Netflix because it's currently focused on spending to acquire content, not necessarily building out their profitability. So it'll actually be really interesting to see how Netflix juggles all of this and to see if they can find a good balance here to please investors while continuing to grow out their business. Funny enough though, their smart score shows the stock is at a strong buy still with plenty of upside from current prices. We can see hedge funds buying as well, but keep in mind this information was reported in the last quarter, and that was before Apple TV Plus was announced with their low $4.99 price tag. Maybe that has an effect on Netflix, maybe not, but this is a risky play nonetheless. Looking at Netflix's charts here, they are struggling and currently sitting under $300 per share, slowly approaching the lows it hit back in 2018. Like I said, the valuation is sky high, so I believe there's still plenty of room for the stock to drop to bring it to a much more reasonable growth valuation. A PE of 120 is simply not sustainable, and sooner or later investors will realize this. So November is actually going to be a very hot month to watch for this space, and that's because Apple TV Plus and Disney Plus both plan to launch in November. So I would keep a close eye on news, kind of see how many people are signing up, see what the interest is around there, because that could actually be very, very detrimental to Netflix's future. All right, so now we're down with 2 stocks. We have 1 more to go. But guys, if you haven't done so already, smash that like button down below to show your support for the channel. Every like that you give me actually helps out the video a ton, so I truly appreciate that. So stock number 3 here is The Cheesecake Factory, and that's ticker symbol CAKE. So this is a new stock to me, so I actually had to do some digging here to find out what this company does, what makes it possibly intriguing, and if I would actually consider investing in it. The Cheesecake Factory is actually a restaurant company and a distributor of cheesecake in the United States, with 211 restaurants currently open and running. They've been around for close to 50 years now and have adapted over the years to cater better to their customer base. The stock has not had a great last 5 years. However, there's a few things about it at its current price that make it very appealing. The PE sits below its average in the 17s, making it a fair value for what the company does, and forward PEs are expected to go even lower, which is a good sign as well. Earnings, however, are mixed with this company, with 1 miss in the last 4 quarters, and the next 2 quarters are actually expected to come in with negative growth year over year. So what I like here is that the expectations are low for Cheesecake Factory, giving the company a good opportunity to beat and send the stock soaring higher. Also, as an added bonus, if you hold the stock, you get a nice 3.38% dividend yield, and that is growing nearly 20% year over year for the last 5 years. They have been increasing their dividends for 7 straight years, implying strength in the business. Payout ratio is around 50%, which is reasonable and sustainable, and gives me confidence that they can continue raising this dividend for many more years to come. Now, the SMART score is fairly mixed here for Cheesecake, with a hold consensus rating. However, a positive sign is that insiders are buying up the stock, so they believe it is undervalued at current prices. It's usually a good sign to see buying from management when a stock price has dropped a ton, because it shows that they believe in the company and in a recovery with a long-term outlook. Now, speaking of the stock price, here's a chart for Cake, and I actually threw in a monthly view here because it shows us a few things I found interesting. The first, that we corrected near 50% on the stock recently, so you're getting a good discount, which is pricing in the negative earnings expected. The second thing I wanted to note is that the stock bounced off its 200 moving average on the month, the strongest level of technical support in my opinion. This implies to me and tells me that buyers are watching these levels closely and don't want to let the stock drop below that. So over the coming months, it'll most likely come back to test this again. However, it will be telling to see what happens here and if buyers can actually keep the stock above this level. Nonetheless, I love that the stock actually pays out a dividend as well. So it gives you a little bit of a cushion there while investing in this. Even if it moves sideways for the next few years, you still get that dividend income year over year. However, let's be real here. If you want my honest opinion, I do believe that the stock is undervalued, and I believe there's actually a very good chance of good capital appreciation in this company over the next few years. But I'm still not 100% decided if I'm going to be dabbling in this, and if I do, it may just be a very small position. But I just want to share this with you guys because it's not really a stock that I see talked about a lot, especially here on YouTube. I personally have already pretty good representation in the restaurant space, so this may not be the best addition to my portfolio, but with these valuations, it's tempting. Thank you so much for watching, and again, if you're brand new here, consider hitting that subscribe button down below and hit that bell notification beside it as well, because then that'll send you notifications every time I release a new video. I have a lot more exciting stuff coming up in the next few weeks. This month my goal is to upload Monday to Friday every single day, so there's tons of content coming and I don't want you to miss out, so join the community, hit that subscribe button. But either way, thank you so much for watching. Don't forget to invest positively, and I'll see you in the next one.